Hi, I'm Guy Myles, founder and CEO here at Flying Colours. In each of these videos, I discuss themes that matter when investing your money. Today, we'll look at the cost of investing and why cost and value for money are not the same thing. There's been a long debate over investment styles and costs, but the core question is, what's the best value for money? Put simply, when is it in your best interests to pay more for investment management? And what does that cost deliver in terms of returns? Let's start with the direct impact of charges on your returns. They play a huge role in the value of your investment. Over 30 years, an investment with a 1% charge might return 307%, but a charge of only 0.25% would increase returns to 382%. While the difference in charges may seem small, they certainly add up. So it's important to control your investment costs. Now, let's look at passive and active investments and value for money. A passive strategy simply tracks a market index with minimal trading, aiming to match market returns, usually with charges at a lower level. On the other hand, an active strategy tries to beat the market through frequent trades and research, but this comes with higher charges and more variability in returns. Now, passive investing has performed well in recent years. This is illustrated in this chart. As you can see, over the past 3 years, firms investing in big global shares using a passive approach have outperformed those with an active one. And even over the long term, passive investments have tended to outperform active ones. The darker colour in this chart shows the percentage of active funds that did better than passive ones over a 5 and 10-year time frame. So at first glance, passive investing seems like the clear winner as the costs are lower and the returns are more consistent. But focusing too much on reducing charges and low costs in general terms could mean missing out on factors that affect investment quality within your portfolio. The fact is that while passive investing works in many situations, it's not always the best option. There are 2 general reasons why you may want to consider active management. The first is in situations where active fund managers have a long track record of improving returns. This often applies when investing in smaller companies or in specialist or less developed markets. The second reason is when you own assets that aren't easily traded on an exchange. This applies to sectors such as property or private companies where you simply can't invest without an active fund manager. So active fund management can be an important part of a portfolio to give you better diversification and to increase your return. The key is finding balance and ensuring any extra fees are backed by better returns and diversification. If you have any questions about today's video, please get in touch. Just email hello@fcadvice.co.uk. Finally, as ever, I've been talking about investing, which means your capital is at risk.